So, well, as I was saying, welcome to you all to this webinar in IQ Option. My name is Laura. I am an account executive manager here in IQ Option, and I'm going to be your host for today in this webinar. I want to first of all to thank you all for joining, and of course I really hope that this is going to be an interesting webinar and most of all just useful for you. Okay, so before we get into it, because we're going to be, as we can see in the screen, we're going to be checking together some basics of Forex. But first, I would like you all to just take some seconds to read this disclaimer. Okay, it's really important for you to understand. It. So in 10 seconds, we'll be starting. Just take these seconds to read it, please. Okay. Perfect. Okay, so let's start, shall we? We are going to check what is in our agenda for today. Okay, we're going to be, first of all, analyzing a little bit what is Forex, okay? How to trade with it, and the availability, okay? When can we trade in Forex? Also, we will be analyzing some very basic concepts, okay? Spreads and pips. It's very important for you to have those clear if you're going to be trading in Forex. And also, we're going to be checking together risk management tools. Stop loss, take profit, pending orders, we'll see them too. Okay, risk and its positive outcome, okay? We will be speaking also about overnight fees. And finally, we'll have our turn for questions and answers. So I really advise you to just comment down all your questions, okay? By the end of the webinar, I am going to answer them all, or try to. And so, yeah, just write them down and we can check them all together at the end. So I really hope you stay until the end so we could speak together a little bit about everything that we're going to be checking here. So let's start with Forex, okay? I mean, if you've been trading with it some time, of course, you know what it is. If not, you might have, or you might know it also as FX or foreign exchange, sorry. So the Forex, we can say, it's basically the process of changing one currency into another. Okay, it's important this because the Forex market is a global marketplace where we are going to be exchanging national currencies against one another. Why is so important against one another? Because this is what you're going to have in the Forex market. Euro USD, you're not going to have just currencies. You're going to have currency pairs. They're going to trade against each other, okay, as exchange rate pairs. We will see in some minutes what this means exactly, okay? When we say that the Euro USD is at 1.21, we will see that. But for the moment, I wanted to clear out this. Why do we trade in Forex? Well, there are so many reasons why you should or why you could want to trade in Forex. So, for example, there are a lot of companies that might use Forex, for example, to hedge against or to hedge interest rate risk, for example. You can also use it to diversify your portfolio. And the main idea that most of you, I guess, you're going to do here is to try to get a positive outcome. So we're going to buy or be buying a currency at a predetermined price and speculate that the price will appreciate or depreciate in time, so you can sell. Okay, so why do we do this? Because there are a lot of factors that can actually affect supply and demand for currencies. We have interest rates, we have trade flow, we have geopolitical, of course, risk, economic strength. Okay, so an opportunity exists to profit from changes that may increase the value of one currency, okay, compared to another. This is the main idea behind this. Who trades? Well, governments, banks, institutions, central banks, companies, hedge funds, and of course, investors, retail traders. This was not like this some years ago. The Forex market is actually a new market. And before, for example, we started trading with brokers and over the counter and through internet. Actually, to the Forex market, only big corporations, big institutions had access to it. We're going to be checking now a fact, and I would like for you guys to answer this question if someone might know. Do you guys know which is the trading volume daily in Forex, in the Forex market? Would you like to guess? Anyone, guys? No idea? Okay, so it can be up to, well, exactly, $5 trillion. Okay, so exactly, Jonathan, we're gonna see it now. $5 trillion are traded every day, so it's quite a sum there. Okay, availability. You're gonna see here, okay, this is important too, because you're gonna see here the schedule for the main exchange in the world. However, one of the most interesting things about the Forex market is that it's a permanent market, almost a permanent one. I mean, you can trade in it 24 hours from Monday to Friday, okay? So, I mean, it's important to know that, of course, you have here the schedules of the exchange. Why? Because obviously and traditionally, we know this for sessions, let's say, like the 3 peak activity sessions, okay? Daily, we have the Australian session, the Asian one, the European one, and the American one. So it's important to take into account these hours, because during these hours is when the markets are going to be more most active, because the banks, corporations, institutions, they are going to be doing their business. So and of course, for example, if you follow the economic calendar, you know that if you're going to be trading in the US dollar only during some hours, you're going to have events. So it's important also to check this schedule, but you need to know that you can trade in Forex 24 hours to Monday, from Monday to Friday, okay? So it's a quite interesting market. How to read a currency pair. Okay, this is what I wanted you guys, because I get a lot of questions from traders about this, and even if they don't ask, at some point some of you have doubts about this, and it's one of the things that it's the essential on Forex, that you need to know how to read a currency pair, because if you don't, you're not going to be able to interpret like what is happening in the market and how it can affect the Forex market. Okay, so let's use this example. We're going to have the Euro USD. Okay, it's at 1.1901. So we're going to have two currencies. The first one is the base currency. The second one is the quote currency. Okay, you have it here. Perfect. Some facts about this second one. The quote currency is also known as Pippip currency. It's important for you to know also the unrealized profit or loss is measured in this quote currency. So imagine that you have an account in euros and you're trading in the Euro USD. The profit you're making will be first calculated in dollars, and then it will get into your account in euros. So there is a transformation there, right? And then the spread is also displayed in the quote currency. Perfect. What is this is the important part. What does this mean? What does it means that the Euro USD is at 1.1901? It means that the quote currency shows how much the base currency is worth as measured against itself. let's see an example to see it clearer. But if I say that the Euro USD rate equals this number, what I'm saying is that 1 euro is worth $1.1901. This is really important. Why? Because this is telling you which currency is stronger. So in this case, if to get 1 euro, you need to put $1.19, it's obvious that the dollar is a weaker currency right now than the euro, because you need more dollars to get a euro. If we go, for example, right now to the euro GBP, that it's at 0.89, I believe. Let me check for today. Right now, exactly 0.89. This means that the euro in this case is the weaker currency, because to get 1 euro you just need 0.89 pounds. Okay, so this is really important, especially when you're going to be, for example, getting into the economic calendar, for example, or reading this, and you're going to see the interest rate. So this currency, it's going to be appreciated. What does it mean? If you think that the USD is going to fall, then, or it's going to be a weaker currency today, you need to know how to read the currency to trade in it. Okay, well, I don't know if that was clear, but I hope so. Basic terms. If you're going to be trading in Forex, you also need to know this. So we have three main types of currencies. Okay, major, minor, exotic. It's important to know this because depending on the currency, there are some consequences in the market. Major currencies always have a USD on one side of the currency pair and any minor currency on the other. Examples. Well, these are the most frequently traded currencies globally. Okay, and which are they? Euro, US dollar, Japanese yen, pound, US dollar, USD Swiss franc, USD Canadian dollar, New Zealand dollar, US dollar, Australian dollar, US dollar. Which are these consequences I was speaking about? Massive liquidity and lowest spreads. Okay, this, I want to take a minute to explain this because it's logical, right? Major currencies, there are a lot of euros, USD, Japanese yen in the market. There is a massive liquidity, but I don't want you to confuse this with volatility, okay? Because I get a lot of clients and a lot of traders just telling me, okay, I want to invest in Forex because it's a very volatile market. Depending on the currency, it is a volatile market or not. Let's imagine that you have, for example, 100 million euros. It is very probable that you're able to change it for dollars because there's massive liquidity. I mean, there's a lot of these currencies in the market, and this also affects the spreads. Why? Because it's just the law of offer demand. If there's a lot of them, obviously the cost of trading on them is going to be lower. What about the volatility? I wanted to just very quickly explain this. Why this market, massive liquidity, does not mean a lot of volatility. It is actually the opposite way. We're going to have less volatility. Why? Because to make a real change in the price of the Euro USD, we need a massive event. We need something really, really, really important. So it's very difficult to see a huge movement in the market. That is volatility, when we see a huge movement. And this is what can happen with exotic currencies. Is the opposite situation, and we're going to check it now. Minor currencies. Okay, minor currencies, any established currency that does not include the USD currency. The most widely traded minor pairs consist on the Euro, GBP, and GPY. So examples of minor currencies, we have, for example, the Euro GBP, we have the Euro Swiss franc, pound, Japanese yen, okay, all of these currencies. And finally, exotic currencies. They include a major or minor currency and then a currency of a developing economy. We have here some examples. For example, we have the euro and the Turkish lira. We have the US dollar and the Hong Kong dollar. the Japanese yen and the Norwegian krone, the New Zealand dollar and the Singapore dollar, and finally pound and South African rand. Okay, the characteristics of this market, these exotic currencies, less liquidity and higher spreads, exactly the opposite that I explained before. Why less liquidity? Well, because it's going to be harder to get those 100 million or whatever amount of, for example, South African rand or Hong Kong dollar, okay? At least a little bit more difficult than euros or US dollars, and this is why they have higher spreads. Let's move on, and we're going to start checking now some examples, some basic concepts, okay? Now to trade on Forex. Actually, we're going to start checking these concepts for trading. The spreads. Well, technically, the spread is the difference between the bid and ask price. Excuse me, guys. First of all, spread is a fee, okay? Because the other day, someone was asking me, how do I use a spread? You don't use a spread. Spread is a fee that is absorbed by the broker, okay? So you don't have to use it. It's just there. And it's the difference between the bid and ask price. Let's see an example. We're going to check it in the platform because you're going to see it graphically and it's very clear that way. But we're going to see this example first. So Euro USD has an ask price. Okay, so ask price would be here graphically, okay, the upside of the gray range that you will see in the graphic of 1.1855 and a bid price down of 1.1851. So the difference is the spread. The difference is 0.004 US dollars. And we're going to see now the concept of pips. Most of you for sure know about the pips. This would be a difference of 4 pips. This is how we measure the spread and how, you know, what are you going to be paying to the broker? Because as I said, it's a fee absorbed by the broker. A lot of questions about why the spread increases, okay? So here you have some reasons why the spread can increase. Sorry, guys. So currency pair not popular enough. Basically, this is what we have been discussing. Less competition for it, not enough liquidity, volatility. Okay, so ask and bid price. This is what is going to determine the spread. Ask is the price at which the market, the broker, will sell a specific currency pair to the trader. So is the price at which you are buying the currency, okay, for you guys. The price the trader can buy the base currency from the broker. Perfect. So if you're going long, if you're going to buy, the trader enters at the ask, and when you close that position, you will get out of the market at the bid price. What is the bid price? The price at which the broker market will buy a specific currency pair from the trader. So the trader is selling. So when you get out of the market, you closes at bid. In the case of a long position, excuse me, guys, if you're going short, what happens? If you're going short, you're selling. So it's logical. You're going to enter at the bid. And when you close that position, you're going to get out of the market at the ask price. Okay, let's see this, however, in how is this represented in the platform. Okay, so we're in the Euro USD, and you can always, guys, see the ask and the bid price here in the lower part of the screen. Okay, you're going to have always there the values. They're updating all the time. Okay, so the actual price of the asset is here, like in the middle of this gray range that you see here. Okay, so right now that the white one would be the price, the actual price of the asset. We have here the buy price, ask price. Okay, it's a little bit up, as I told you before, and then we're gonna have the sell price, the bid price. down here at the end, the lower part of the range. Okay. I will show you, however, because it's very nice in the platform how you see it. When you just go to the buy button, you will see that there is automatically like a green or arrow that appears in the platform, and you see where are you opening your position. Your position is you're always buying. If you're going long, for example, you're always going to be buying a little bit up. If you're going short, you're always going to be opening that position a little bit low. And you see it perfectly in the screen, okay? So this is what we know as the spread, this difference. And how do we charge it? Well, we're going to charge half of the spread when you buy, because you have the current price in the middle, and you're going to be opening the position a little bit up in the case you're buying. So that difference, we charge it when you open the position. And then when you close, we will charge the other half of the spread. Okay, that is how the spread works. In case that you cannot see these values, okay, the bid and the ask price, you just need to go to settings. You have this button on the lower part of the screen. Then select appearance is the first option that you're gonna see there. Okay, then you just have to scroll a little bit down, and you will find this option, information on the chart. This is where you can enable this option. Okay. Limits. How to trade in Forex. Actually, some things we have to check on the platform. So to open and close positions, okay, as I told you, 24 hours from Monday to Friday, not weekends. The minimum investment, $1, okay? Maximum investment is $20,000. It depends on exposure. What does this mean? Because I guess that I don't know if you've had any issue with this, or if sometimes you wanted to open a big position and you couldn't. Exposure. It's an important concept, okay? And it's not a concept only for us. It applies to every market maker, every broker, okay? Exposure refers to the total amount that can be invested in a single position. Each asset has an exposure, hence the traders have certain limit of funds. They can invest in certain assets to manage risk, okay? So basically what can happen, that you want to open, for example, let's say a position of 1,000 euros in the Euro USD, and you receive a message from the platform saying that, well, the limit has been exceeded. This is a matter or a problem of exposure, okay? And you will have to just reduce your investment, and you will be able to maybe open a position a little bit lower, a little bit smaller, sorry. Why or when does this happen mostly? Well, periods of high volatility, okay, which can adversely affect the exposure to prevent Sunday currency fluctuations. Okay, let's continue. Another important concept in Forex, PIP or Pippet. Okay, so it's important because it's, well, you can see here the definition. It's the unit of measurement to express the change in value between two currencies. It's a PIP. It's important because if you're going to be trading in Forex, you're going to be listening a lot and about this concept, and PIPs here and PIPs there. So it's very important that you know how to use this this concept. Okay. So it's the fourth number after the decimal point. We see here the Euro USD is 1.1051. So the fourth number after the decimal point is the PIP. In this case, the last one there. Okay. We will see the exception of the Japanese yen. There are other exceptions, but Japanese yen is important, and the pips are measured differently. So we will check it now in a second. And the pipette, well, the pipette is a tenth of the pip, is the fifth number after a decimal point. Okay. In this case, for example, we can check that the pound US dollar is 1.3543. So this last three would be the pipette. You can also measure the movement in the market using pipettes, but it's more common using pips. Okay, so why do we use this? Because if you're trading, for example, in the Euro USD, and you have just started trading in Forex and you don't know a lot, and you suddenly read in a newspaper or read in a web, the Euro USD has come up a pip, or 10 pips or 20 pips. So you need to know how to read this. So in this case, it's very easy now that you know this information. If Euro USD, for example, moves from 1.1050 to 1.1051, that is a pip movement, an upward movement of a pip. Okay. Japanese yen exception. So in this case, you might see that, for example, the US dollar, Japanese yen, now this is different. We don't have all those numbers after decimal point. We have less numbers. So in this case, sorry, the pip is the second number after the decimal point. You see it there. So if the US dollar, Japanese yen is 123.456, this 5 would be the pip. And this way you can measure also the movement, okay, in this kind of currency pair. Okay, so this is just a simple example for you to understand how can we measure the movement of a currency using the pips, okay? So imagine that we're checking this first one, okay? And just a couple of minutes ago, this is the Euro USD, and the Euro USD was 0 point something. So in this case, the movement would be of 10,000 pips, okay? In this case, the movement, this would be 1,000 pips movement, 930 pips. This is a more likely movement in the Forex market, okay, for a daily basis. Okay, so we can speak about a 30 pips movement if this was a 0 and then suddenly came a 3. And we have the column here of the pips and then the pipettes. It's a 10th of the pip, okay? It's just for you to see this example and have this clear. Let's check it, guys, just a second on the platform, okay? Give me a second. I'm going to change to the platform very quickly. Okay. So everything that we've checked until now. So this is what I wanted to show you, for example. Let's put just 5 seconds for you to see the spread very nicely. Okay, so you can see it here. When I was talking about the spread, I just wanted to show you here, because if you just go to the bottom buy, you suddenly see that there is a green arrow there, and it is telling you where are you going to be opening your position. So this is how in our case, an IQ option charge the spread. So it's going to be charged just that half when you open the position, and when you close the position, you're not going to see it graphically, but you know that we're going to charge the second half, okay? But you can see it here. That would be where you're opening your position. Okay, you have also here, okay, this is important, the pip value, which also checked it. The pip value, you can go to this question mark, and you will see that this is the estimate value, okay, for each 0.0001 point change in the Euro-US rate. This is an important concept, because depending on the amount that you want to trade, you're going to see here the pip value, and you're going to be able to calculate more or less the profit that you are expected to get, or the loss also, remember, depending on the movement that you're expecting. So let's say that you are analyzing the market today, okay, and you're expecting that, I don't know, there is a report that's going to be released for the US dollar, and you've analyzed the market for a couple of years, and you expect that because of this report, there's going to be a fall in the Euro USD of 30 pips. Okay, let's imagine this. So I want to make a trade-off, let's say $100. We will check the multiplier now, but you can check here the pip value. So you're going to get 25 cents for every pip the currency moves. Okay. You also have the spread here, guys, for you to check it. And remember, you also can check here the ask and bid price. Okay. Now, if you go there, I don't know if you check it here. Perfect. Okay, so let's continue with the presentation. I don't know, guys, if you've had any issue. Okay, I think that they're answering you. Okay. Okay, let's continue. Sorry, guys. We're going to check now. The multiplier. Okay, the multiplier to trade in our platform, it's a very, very important concept. Okay, it's also known as leverage. Why is this is important? Because all the products that we have, they are CFDs. They include a multiplier. So you need to know how to use it, because it has, of course, a lot of advantages, but it is what makes riskier the CFDs. Okay, our products. So I'm going to explain everything about the multiplier for you to have it clear enough. So what is the advantage of using a multiplier? We were talking about the massive liquidity, the less volatility of the market. And this is true. I mean, the daily fluctuation of the exchange rate of currency pairs rarely exceeds 1%. Okay, so you're not going to see one day or per day a huge movement in the market. So that is that way, especially when you're doing, for example, short-term trading or day trading, it's a little bit more difficult to make a bigger positive outcome without a multiplier. Using a multiplier, your profits is going to be magnified. Also, your losses, we're going to check this now. So this is the reason why you should, you could want to trade with using a multiplier in Forex. Okay, so it's a tool that with which the broker allows the trader to trade with larger volumes of a currency pair without investing the full amount required. Okay, what does this mean exactly? Well, you know that we have a 30 multiplier for Forex. So if you have $5, okay, and you invest $5, you will do this profit or this loss depending on how the market moves. If you now use a multiplier, your investment is no longer $5. Your investment is those $5 multiplied by 30. So your investment is going to be at the end, your position, the position you're going to be opening is $150. This obviously is going to magnify your profit or your loss. So this is why using a multiplier might be interesting. We just checked it. We have it there. You will just settle the amount, $5, multiply 30. And here in the volume, you're going to see how much is worth your position. Okay, the position you're going to be opening. Increasing your leverage magnifies both gains and losses. Okay, I explained this. First of all, before getting into the platform, I also wanted to explain something, and it is that the multiplier, the reason why the multiplier makes or tends the position or the trading riskier is because the position is going to be or might close faster. Why? Okay, so imagine that you trade with $5 in the same example, okay? And okay, so the market start moving. So in a normal circumstance, in order for that position to close, you would have to lose your $5. Okay, so until the market doesn't move enough for that to happen, your position might continue open. What happens when you have only puts? In this case, when you are trading with a multiplier, you will have put $5, but your investment is $150. So you're trading with $150, but you cannot you cannot lose more money than what you put. So when you lose those $5, your position will close. So imagine the percentage that you have to lose of that position is minimum in this case, okay? So that is why using a multiplier is risky, and the higher the multiplier, the riskier the position, or the trading, okay? This is the reason, because the market is going to start moving, and when it moves against your position a little bit more than expected, and then you would lose those $5, your position will be closed, okay? So we are not talking now about losing 100% of your investment. You will have to lose only this percentage. Okay, so what we said, let me check. This all we checked. We have the median price here, the current price of the asset, the investment amount $1 with a 30 multiplier, a leverage of 30. That would be a $30 trade. Okay, there you have your volume. You have also here the pip value. So every pip that the euro USD moves, we would get the $0.003. We have here auto close. We're going to check that just in a second. They're very important tools that you have to take into account. Purchase order is here. Okay, we're also going to check it right now. And this is important. Expected outcome. Here, you can calculate, you can just check what is the expected outcome of profit or loss. Okay, depending on the direction of the market and where it is expected to get the price, you can calculate this way the outcome. Cost of spread, ask and bid price. Okay, just to remind you, they're there. Risk management tools, guys. This, for every trader, I believe, okay, they're very, very important tools that are going to help you manage the risk of your trading. Why? Let's check it together. We have different tools available in the platform. We're going to start with stop loss and take profit. Stop loss, a risk management tool used to protect against further losses. It automatically closes an open position when the exchange rate moves against you and reaches the level you specified. Okay, how does this work? So it helps in managing losses that may occur. Perfect. So imagine that you open a position of $10 with our leverage of 30. So we are opening a position of $300. And I don't know, we're expecting that the Euro USD is going to go up today because of whatever analysis we did. Okay, I don't want to. I need to work. I have family. All of us, we are very busy with our own lives, and you don't want to be just checking your position all the time to see, oh my God, if the Euro USD is going down and suddenly I'm going to lose everything. So this is why the stop loss is so useful, because you can say, okay, I put $10, sorry, and I'm willing to lose actually $5, so 50% of my investment. You would just put the stop loss in 50%, and you can just forget about your trade. So if it goes up, that would be great. You're going to start winning money, and whenever you can just get in the platform, close your position, and get your profit. And if you lose, you know that the stop loss is going to be activated automatically, and your position is going to be closed when you have lost $5. Okay, so you know that you're not going to lose everything. Perfect. Take profit. The other way around. A risk management tool used to automatically close an open order when the exchange rate reaches the level you specified. So the same example as I just gave you guys. You have this $10 that you put in the Euro USD, and you said, okay, maximum I want to lose $5, 50% stop loss. Perfect. And I don't know, I think it's going to go up a lot today. So I want to, I don't know, take profit of the 50% too, let's say. So when I have $5 profit, I want my position to close. So you will be able also to do this, and you can forget about your position in this case totally, because the other way around, if you don't put the take profit, the price might go up and then fall again, and you will lose your profit. But this way, you can also manage and you lock in your positive outcome. Okay, perfect. Now, these two risk management tools are subjected to slippage. We are going to see this concept. It's also very important because it's not something that happens only in IQ option. It happens in the entire market, and you need to know how to, to be prepared to when a slippage happens. We will check it just in a second. Let's see the trailing stop. This is a tool that we offer, and a lot of brokers they don't. A lot of market makers they don't, and I think it's, in my opinion, it's this tool. It's great. Dynamic stop loss. Okay, so I'm going to explain a little bit how it works, because a lot of you have questions about the trailing stop. So the key feature is that as long as the market price moves in a favorable direction, the trigger price will automatically follow it by the specified distance. Okay, I will put you just here. You have a graphical example. Okay, you settle. I don't know if you can check it there, guys. You have in the auto clause a 10% profit and a minus 5% stop loss. So you open the position here, and afterwards you can see a big green candle that goes up, and your stop loss is no longer 5%, is 2%. It moved with the market. Why is it a very or an interesting tool? Well, because imagine that you let's use the same example as before. So you open a position of $10. You have $300 with that leverage of 30, and okay, so you're willing to lose the 50% of your trade. Okay, those $5. So you can put a stop loss of 50. In this case, you just put the stop loss, you leave the computer, and suddenly the price starts going up, going up, going up, going up, and suddenly it falls again and hits your stop loss, and the position is closed. What is your outcome? You lost $5. Okay. What if you use the trailing stop? If the price starts going up and going up and going up, that stop loss that has a difference of the 50% from your initial, the initial point where you open the position, is going to follow the market going up. So what happens when suddenly the market crash here? This is stop loss. Trailing stop is not going to move. So at the end, if the market went up a lot, you're going to get a profit, not a loss, because well, I don't know if I showed it with the hands graphically, but it is following, and when the market starts follow, here is where it's going to stop. So basically, your profit, or the profit that you get in that upward trend, you're not going to lose it entirely. Okay. I don't know, because it's a little complicated to explain it if you're not, if I don't have something to show you or to write, but I hope you understand it, guys. Okay, this was the example. You have the stop loss of 5%, the price goes up, and then the stop loss is not anymore 5%. Finally, balance to keep position open. I have a lot of questions about this one too. So you know that in regulated market, in Europe, we have this 50% automatic stop loss, right? There is a way to avoid it, but that way has consequences. This is what I'm going to explain right now. So if you want to assume higher losses than the 50%, because normally if you, the automatic stop loss is 50%. If you lose 50% of your trade, the position will close. What if you, imagine that you are expecting the price is falling, but you know at some point it's going to go up, so you don't want to lose that trade, and you're willing to assume a bigger loss. In this case, you can, of course, either set a higher stop loss, okay, you can just put, for example, 60% stop loss or 100% stop loss. But you can also activate this option where you find in the auto close button, okay, the last option is use balance to keep position open. What does this mean? This means that your position is not gonna close, okay? You can have a 200% loss, the position is not gonna close. But what happens? You need to have balance, because every time that your position gets to a loss of the 50%, okay, and it gets above the 50% loss, there's going to be a deduction from your balance to keep that position open, okay? This deduction is a 20% of your investment. So let's say you opened a position, you put our $10, okay, and that position, well, the market start playing in the opposite direction, and you start losing, and suddenly you are in a 51% loss. You will see that a 20% of your investment, so 20% of the $10 that you put in this position, €2, will be discounted from your balance. Okay, when your position will go up again 60%, this deduction will happen again. 70% losses, the deduction will happen again. What happens in finally you are right, you make your homework, and actually you were right, and the position starts going in, or the market start going in the direction you wanted. All these deductions will come again back to your balance, okay, once the losses are below 50%. Okay, guys, so when you want to keep a position open, using the balance, you activate this option. You need to check that you have enough balance in your position, okay? Because if not, the position will close automatically. If you have your balance at 0, the position, and suddenly your position goes from 49% loss to 51% loss, that position is going to close. And as I told you, if the price recovers to 50%, the balance is recredited. Okay, purchase order, also very useful. The ability to execute a position at your desired price range automatically once the price is reached. So what does this mean? Well, you have the setup here how to do it. So imagine that you are expecting the asset to go to a certain price. Okay, so you have to set the desired price, then your investment amount, in case you want to put a stop loss or take profit, and then the direction, either you buy or you sell. Why is this useful? Because imagine that, well, you use, for example, resistance and support lines, and you know that there is a very like in the example, strong support at 1.18, okay, and the Euro USD is right now at 1.90. So I mean, you don't want to keep checking all the time the market to be just aware or when the Euro USD is gonna hit the 1.18, and then you have to buy. So you can just set a buy order. So you would enter the platform, select the exact point where you just want to apply this pending order, and press buy. I will show you where to check this right now in the platform. Let me check. Yes, let's go to the platform just a second, guys, and we will see how can you do this. Okay. So, okay. So you have two options, okay? The long one is go here below the spread. You have purchase at, I'm gonna, however, let me put this in 1 hour, for example, for you to check this better, guys. Okay, so let's say, for example, that, well, look here, I have a pending order. Okay, so let's assume that when we get to this point, okay, to this one, I think it's going to reverse and I want to sell. So in this case, you would go to purchase. You would put this price, okay, 1.21798, and then When it's activated, you will see that you have a clock here, a little watch, and then you will just press sell. Your pending order will be activated, and you can check the pending orders, go into portfolio, pending, you will have them here. Another way to do it, the short way, you just have to go here with the mouse. You see that you have this plus here in the price that you would like, or the desired price, let's say like this. You press in the plus and you can either create an alert or just a pending position. You would press plus and then automatically you see the watch here. You will have to buy or sell. Let's sell. And you can perfectly see here your pending order. Okay, perfect. We're almost finishing, guys. I hope you're following me and I'm not being too intense. Okay, so let's finish. We're almost done. Let's check slippage. Slippage, as I told you before, guys, it's something that happened in the market in general, okay? And I don't know if some of you has happened at some point, but it's not only a bad thing, it can be also a good thing. Let's see why. So it's a process when an order is filled at a price that is different than the requested price. What does this mean? Well, when does it happen? Okay, we'll check this after. What does this mean? So let's imagine that you want to buy, okay, because there is the price of the euro USD is starting to go up and you want to buy. And suddenly, in the second that you press the button to buy, the market goes crazy and there is a peak and there is a huge candle going up. This is a very big movement and it happens very quickly. So if you press at that second, what is going to happen most probable is that your position is going to be activated, of course, but it's not going to be able to enter the order book because there are a lot of orders going at the same time, and you're not going to be able to enter at the same time you press the button. So you're going to be just your position is going to open a little bit later. So you're going to be you're going to get another price, okay, the next available price. Okay, when does this happen? High volatility, low liquidity. We check that these concepts are correlated. It is very common, for example, to check this with the stocks, just for you to understand, guys, the concept when the market opens. You can always see that, well, not always, but a lot of times when a stock, you're following a certain company, and suddenly when the market opens, the price was here and there's a huge gap and suddenly the price is here. So imagine this is because, well, there's a huge fall and suddenly the market opens and the price is here. So imagine that you wanted to sell, okay, because you knew that the price was going to fall, and you put a pending order here. So here is not possible. The order book is not going to get this order. So you're going to get the next available price where everybody's getting these prices. Okay, so this is like, I hope you understand it with this example, because it can happen when there are like very quick and big changes in the market. And it's not something that is, it happens in our platform. It happens in the market in general. So you are not going to get that price that you wanted. You're going to get the next available price. It happens. It can occur with all type of requested orders, including also stop loss, take profit. Okay, when you suddenly put a stop loss in the 50%, it's here the 50%, but suddenly here there's a peak, there's a big movement, and you get the stop loss here. This is what happened with the slippage. Let's see an example here. So very quickly, bid price. You have it here. So the bid price, in this case, we're selling. Okay. That is why we're opening the position in the bid price. We're going to sell. This is the price at which I want to sell, okay? Because I want to press the button, and that is the price at which I want to sell. But what happens is suddenly, imagine that appears there a huge candle that goes down, 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 and you do not enter the market there where initially was the bid price you enter, a little bit lower. Okay, so in this case, slippage happened and you got the next available price with a difference in this case of 2 pips. Okay, the same can happen in a long position, of course. You ask the ask price in this case. This would be the price at which you would like to buy, but suddenly in this case there is a huge candle going up, and well, you get the next available price, which is this, in this case, at two pips a little higher. This is like the bad scenario, let's say, guys. But of course, slippage can't play in your own interest. And for example, imagine that, well, you wanted to, let's go, yeah, in this example, for example, let's say that you are you wanted to buy because the market is gonna go up, and you're expecting this. But before it goes up, suddenly there is a fall. There's a huge candle that suddenly appears going down, and the buy that you, or the price at which you're buying, is much lower. And imagine that your position opens here, and then the market shoots up because that is what you were expecting. So in this case, of course, you would get those 2, 3, 4 pips difference in your own interest. So it doesn't have to be always a slippage, a bad thing. Okay. Finally, overnight fees, also known as rollover or swap, an interest charge for holding a leverage position overnight. It's a procedure basically of moving open positions from one trading day to another. If a trader extends his position beyond one day, then they will be dealing with a cost gain depending on prevailing interest rates. This is the reason why we have overnight fees. Okay, swaps fees are charged because of the difference of interest rates of the two currencies. Since you're not physically receiving the currency you buy, not delivering the currency you're selling, the broker should pay or charge an interest rate difference between the pairs of currencies. Okay, this is the reason. And let's see just 2 examples, because in Forex we have 2 different type of swaps. Okay, positives or negatives. You might have seen this in the platform, that sometimes you have a plus just next to the overnight fee. Okay, so a positive swap example: a trader buys euro USD. In fact, the trader is selling euro, okay, in this case we've seen this, and buying US dollars. Euro interest rate is 2%. Imagine, of course, we don't have these numbers right now. And the US dollar interest rate is 1%. So 2 minus 1 is 1% positive swap. Negative swap example: a trader sells euro USD. Okay, so in this case, we have the same numbers for the interest rates. The deduction is in the opposite direction. So we have -1 of interest rates. Okay, great. No overnight fees will be charged if you close your position before 11:59 GMT. I will take just 1 second to show you guys in the platform where you can check this this information. Okay, it's very simple. You have again 2 options. I will show you both of them, because in here, for example, if you go to Euro USD, okay, you go to settings. Sorry, excuse me, guys. No, you go to the information of the asset, okay, and you are going to find here trading conditions. Okay, here you have overnight funding to buy, overnight funding to sell, and the trading schedule, of course, and also the overnight funding. You have it here. Okay, so these are the trading conditions in general for you if you want to calculate them. But also, let's say that we have this $100 we want to invest, and let's, however, take this way. We want to buy. So in this information here, you will say overnight funding, $0.54. This is what you're going to be paying every night. Okay, guys? Perfect. Also, let me show you this. If you go to, do you see this question mark? You will see the entire schedule there and what are you going to be paying every day. Okay, you can see that Fridays, for example, we charge for the whole weekend. So that is why the fee is higher. Okay, since today is Friday, that is why we have there a higher fee. Okay, let's continue because we are just now, yes, we're just finishing this. Okay, so finally, guys, what makes Forex so special? You can trade on a variety of currencies. There is no expiration time. You can close your position whenever you want. Upside can be up limited if, of course, your position is in your the position is in your favor. Risk can be 0 from 100%. Okay, 24 hours from Monday to Friday. Have a variety of risk management tools at your disposal through the platform. We've seen them. Stop loss, take profit, pending orders, trailing stop, okay? And as we said at the beginning of the presentation, over 5 trillion dollars of trading volume in a single day. Just something extra, you know, guys, that there are a lot of famous strategies but you might want to, or you might have listened about this one, scalping, day trading. Scalping and day trading are very famous ones, okay? They're short-term trading strategies. The first one usually takes seconds or minutes. The second one, maximum a day. You never hold positions overnight. Swing trading, normally you just use well, a range and you try to trade using the resistance and support lines. And finally, position trading, that can, it's usually long term and can trade, the period of trade can be weeks, months of or years. Okay, guys, so for me, this would be, I really appreciate you guys for staying until the end. It's been a long webinar, I know, and I've explained a lot of concepts. I just want to, before I go to the questions, I just wanted to let you know that we would like to continue doing these webinars. So I mean, if there is something that you think guys should be clear, or you want to check any strategy for Forex, or you are really interested in something that I mentioned, just let us know. Okay, we for sure we would love to do more webinars and explain you more things about this, guys. So okay, let's check now some of your questions. 1 hour is not that long. Thank you so much, Dinika. Okay. Okay, so let's start. I'm going to be answering some questions. So I have here a question of Mauricio Zurolo. It is possible to trade only spreads? So as I told you guys, I got this question also from another client the other day in our platform. I mean, the spread is just a fee that we charge, so it's not possible to trade on them. Okay, just every broker just charge the spread, and the cost of the spread in order for the trader to open a position. So it is considered as a commission. Okay, let's check more questions. I have okay. Okay, I have here another one from Donato M. And this was the question. I would like to do back testing based on specific Forex news. And I was wondering if there is any way it can directly go straight to a certain day or minute. So we're going to go just Donato. I don't know if you're here yet. So I'm going to go to the platform to show you. So the quicker way, I guess, I don't know if I'm gonna be solving your question here. Okay, let me go to the platform 1 second, and we will check it together. The easiest way, because I don't know, for example, if you use the line Donato or the candles. If you use the candles, it's very simple, because imagine that you're in the Euro USD and you usually trade with 1 hour candles, or even short term, and you're in 1 minute. Of course, if you have to go 3 days a week, it's gonna, I mean, 3 days ago, it's gonna be impossible. However, it's very easy to do it. So then you can just change, for example, a day candles, just zoom out a little bit and go, just scrolling in the platform. You can just go a little bit back in time, and if you wanted to check a specific movement that happened because you were analyzing the news a certain day, you can just press here and zoom in, and then again change the candles, okay, to minutes, or 1 hour, or whatever you might like. Okay, I think that's, I don't know if that answered your question or not, Donato. I think okay, great. I think that's the easiest way to do it. Okay, let's continue okay, with more questions. I have here another of Taja Miyara. Sorry, I can't change the multiplier. It's always fixed. 2 or 5. Is it matter of law in Europe, or should I change something on the parameters? Okay, the multiplier that you see, Taha, yes, it's fixed. It's fixed depending on the market conditions. It's true that exceptionally certain assets you may have different multipliers and you will be able to change them. But for the moment in Forex, um, we offer a 30 multiplier, okay, and it's fixed. And okay, great. So let's continue with more questions. Another one from Donato. Okay, so Donato asked me, how much does the trader lose in case a multiplier of 30? The maximum the trader can lose using any multiplier is always limited to the amount invested. Okay, remember how we explained it, Donato. The multiplier works that way. It will, of course, magnify your profit or your loss, but it's not a matter that it will magnify your loss, and instead of losing without a multiplier only the 10%, you can lose with a multiplier 120%. It doesn't work like that. The thing is that it magnifies your loss or profit, because you're gonna lose or have a profit more quicker. I don't know if you understood, Donato, how when I explain the multiplier, how it works, because I don't know if this question was before or after that. Okay, but I hope you understood it. I mean, if you use the 30 multiplier, it doesn't matter. That what it's going to happen is that your position is going to close quicker. Okay, but you're going to lose 50% maximum automatically. Or in the case that you want to set a higher stop loss, then of course we explain the deduction on the balance. Okay, great. Luca Cigarini. If I put okay, great, Donato. If I put a stop loss at 50%, doesn't mean that I lose the half of what I bet. Um, exactly. This is Luca. This is what it means. You only lose the 50% of what you put in the position. Okay, I don't know if you are still here or if this is clear for you, but exactly, if you put, like we explained, if you put $10, then if you lose the 50%, you will lose the $5, and the rest, the other $5 will get back into your IQ account. Mauricio Zurolo again. What are the commissions for the platform automations? if you are referring to the stop loss, take profit pending orders, I don't know if you're referring to platform automations with that, but we do not charge any commission for those. Okay, so you can use them whenever you want. They're totally for free. Okay, we have also Tiffany here, Tiffany Dabus. Can you do a webinar for stock trading? Well, of course. Thank you so much for your interest. We will take this into account. Stay tuned, and I hope we can do more webinars like this one. I have another answer here. Sorry, question. Rosemary Sutha. I hope I said that correctly. If not, I'm so sorry. When can we learn how to use the candles? Um, the same answer as Tiffany. I gave Tiffany, sorry. We are going to be launching more webinars. Yeah, it's important how to use candles. So it's a very good suggestion. And of course, Rosemary, we will take it also into account. We'll try to do a webinar on that because checking the patterns on the candles um, and understanding them, what do they mean, and being able to, depending on the type of trading you're doing, being able to settle them correctly, the period of the candles, for example, it's very important. So we will try to check that too. Robert Harrison Brown, do you do you know the best way to find news that has an influence on the market? Okay, I will show you something in the platform, guys, because, for example, regarding Forex, there is a lot of website, of course. We always speak about when investing.com is a very big one, okay, and it has a lot of information. But I want to show you how you can check this information on the platform. That way you can have everything on one same place. You see here these buttons on the right. So you have here market analyst. Here you have a lot of information. Okay, you have news. Okay, from a lot of different sources, so you can just check this here. You also have the Forex calendar here. Okay, let me just very briefly, because for sure we will make another webinar on this, I hope so, but I will explain very briefly the Forex calendar. You have here the currency that it's going to affect, the events that are happening today that have, let's say, more importance, or that are likely to create more volatility in the market. Okay, a bigger movement. So you have the date, you have the time. This dots, okay, means the not the importance, but the probability of this event creating volatility in the market at that time. So 2 points is middle, 3 points it's a big chance, let's say like this. Or there are events that normally they do create high volatility in the market. Then you have the name of the event. If you press here, you will check all the information. So you normally, let me show you one that actually, okay, here. You normally will have the forecast here, the currently, and the previous. This is the thing that you are going to be focusing on. And when, so whenever you would like to follow this and see what happens with this event, you just have to check at the time that the event is going to be released, the currently data. Okay, also you have here earnings calendar. Okay, for stocks, all the stocks that are going to be releasing their earnings report. Okay, I don't know if there are more questions, guys. Let me check the chat. Have here, Dinika is asking me, the trading on this platform is only for scalping. If, for example, I buy S&P 500, what about the dividends? If I have the position open for 6 months, I will receive the dividends. Okay, this is important, Dinika. And for all of you guys, the products that we offer in the platform, they are all CFDs. Okay, contracts for difference. So when you are trading, for example, in S&P, or you're trading in a stock, you're not actually buying the asset. You're just making a profit or a loss, okay, on the difference in the price. So there are no dividends because you're not buying the stock. You're not buying the cryptocurrency itself. You're just saying, okay, when you open a position, you're saying that the price is going to be up or down in some minutes or in some days, whatever the time you want to keep the position open. And this is how you make the profit or the loss. Uh, However, Dinik, I just wanted to check. This has nothing to do with if it's, well, nothing to do. Um, the I mean, scalping is a strategy in short term, but doesn't mean. I mean, you can also do scalping in other brokers without CFDs. It's there are different things. However, we will see these things in other webinars, I hope. So, uh, okay, I know what you mean. Okay, um, okay, great. I don't know if I answered, Dinika, or you, or if it's fine with this answer. Okay, what else? I don't know if you have more questions. Okay, I have here another question. Sorry, for Jersey. Um Okay, so which indicators are showing the best moment to open transaction? Okay, this is a very complicated question to answer just in some minutes now. I hope, Jersey, again, um, we are going to do, I hope, more webinars on strategies and how to use the indicators we have available on the web, sorry, on the platform. So we will check them together. It's very difficult to answer this question because it depends on the type of trading. Oh, sorry, it depends on the type of trading you want to do and the type of assets, the time frame you're going to use for your trading. So giving you or telling you just an indicator, it wouldn't be the right answer. We need to get a little bit more in detail and see what type of trading we want to do. Okay, I think I have more questions here. Okay. Um so guys, we are running a little bit. Okay, Jersey, great. We're running out of time. Really, I want to thank you all for having, I mean, for being here for 1 hour and 20 minutes. It means a lot, guys. I really hope this was useful. Um, and I wanted to also to inform you that the replay will be sent, okay, for you all guys to have it if you want to have, well, to check it again or if you couldn't watch it in the whole webinar. And really, thank you so much, guys, and really hope to see you in other webinars. Okay, I really hope you have a nice afternoon and a nice weekend, guys. Thank you.